Good morning, everyone. Sorry, my voice was crackling there for a moment. I felt like a teenager. Good morning to our trading room. My name is Eric Senft. I'm going to be your host here for the next hour and a half or so. The markets just opened up. Oop, hold on a second here. I need to get you my screen. There we go. Today is going to be an odd day. Today is November 11th. That's Remembrance Day here in Canada, Veterans Day in the US. Businesses are closed today in Canada, not so much in the US. Um, so I'm not exactly sure what to expect out of the market today. The markets sometimes behave a little bit peculiar on holidays, even the smaller holidays, or what would be considered a lesser holiday in the US. What you're looking at here is the diversified trading system, and I'm going to give you just a real quick overview for those of you who are new in the room this morning. The diversified trading system is called, it's diversified because we're looking at the market from three different points of view. Here in the top left, we're looking at the Hawk Scalper. This tool has been specifically programmed to pick up scalp signals. Here in the top right, we have the Falcon Swing Trader, and as you might have guessed, it has been programmed to pick up swing signals. The bottom left is the Eagle Trend Trader. So those are our three tools. Here on the bottom right is the latest addition to the DTS family. This tool is called the Raptor. Now the Raptor is actually kind of a hybrid. It incorporates elements of the other three birds all into one chart. For those of you who are looking more for a one-screen trading system, you may be more interested in the Raptor because it does incorporate elements of the scalper, the swing trader, and the trend trader, but it does it all just on one screen. What was I going to do here? Oh yes, let me preset my trade parameters. All right, here we go. All the signals, regardless of the tool, develop the same way. When the signal is beginning, when you're starting to meet some of the trade parameters, you're going to print a warning dot and you're going to get an audio alert. Once all the trade parameters are met, you're going to print a triangle and a hash mark. That tells you that everything is set to go and it's time for you to make a decision. Now, what confuses some people about the DTS system is it looks like you're getting a lot of signals when in actual fact, even though you're seeing a lot of arrows and triangles and hash marks here, we're not necessarily keen on taking every single signal. We're going to be focusing on the higher probability signals. And I'll be explaining some of those as the morning goes on. Here, just out of the open, actually, on our Hawk Scalper, we got a first micro-macro cross signal. That's pretty easy to identify. It's when the micro line, that's this thin one, crosses the macro line. Everything is in sync. So we've got red trend lines, red signal, red bars, red filter. That's a very strong sell signal, and you can see that that one's had some very nice follow through on it so far. Here on the Falcon, I bet we had a comparable signal. Oh, actually the Falcon signaled a little bit late. The Falcon signal, which is the trend change signal, did not develop until a little bit later. And again, that's because this is a swing trading tool. Its parameters are going to be a little bit different. And I think we hit our profit objective there. Yeah, we just hit our high probability profit target. So again, you're going to see a lot of the signals rely on confluence. So in this case, we have a red trend line, red bars, red signal, red filter, and it's the first signal that developed after the trend line changed color. So the trend line changes color here. This is the push that changes the trend line color. here's the buyers trying to fight the market back. They're only able to muster one bar, and then we come back with yet another sell signal. And that was, again, right around this morning's open. So it's looking like the sellers trying to put in a little bit of a push. Quick review here of the Eagle Trend Trader. And here on the Eagle, we're going to see some signals that are just slightly different. Here's a very high probability signal on the Eagle. The Eagle, you've noticed, has this band running through it. This gives us our directional bias. And whenever we intersect the hard edge of the trading band, we anticipate some sort of reaction. Sometimes that reaction will come in the form of a green bar reaction. We refer to this as a hard edge bounce. And you can see the market trades into the hard edge, comes out with a buy signal, and then had some decent little follow through to it. Sometimes it will come a little bit harder into that hard edge and actually slip up the bar color. In this case, we started printing red bars, which would typically be bearish, but then we come back with a green signal, a green buy signal. So what this is actually showing us is that there was a rapid move lower. The sellers thought they had control of the market, only to see the buyers come back, take control. Very, very high probability signal, those red bar buys. And you can see we had nice follow through the Asian session into the overnight. And here we are again. Red bar, green warning dot, but we didn't complete all the parameters for the trade, so we don't have a buy signal there just yet. Just for kicks, let's shoot a trend line across the bottom here, see how we're, oh yeah, getting good trend line support so far. What I'm looking for at this stage is a retest, a test of the extreme. A test of the extreme, for those of you who haven't heard the term, I don't know if it's my term or if I read it somewhere, but it's a pretty basic concept in trading, really. Right now, this is our extreme price, the high. Prices have come down, and they're trying to rally up. If prices fail on this rally, there's a very good chance that they're going to try to head lower. All right, and the reverse happens as well when the market starts to bottom out. It puts in a bottom, prices try to rally against it, sellers try to recover the market. If that fails, it's a very good chance the market's going to head higher. This is called a test of the extreme. Also, very important because it helps us qualify our signals a little bit better. I got a question here from Bo. Bo is asking, what's the ideal stop loss and ideal profit target for the NQ day trade? Well, Bo, it depends a little bit. Oh, and by the way, folks, I'm looking at the NQ here. That's kind of my favorite market to follow to day trade. But I'll look at any market you're interested in. I'm sure there's a couple of E-mini traders in here. On my other monitor, I'm watching gold and crude oil. So yeah, just let me know. Yeah, and Brian's asking about the about crude oil. So yes, we'll get into crude oil here in a moment. And I see we just had another signal trigger. So DTS owners, you have to forgive me a little bit as I explain some of these questions this morning. I'm looking here at the Hawk Scalper, and we just had a macro pullback signal trigger and a hard edge bounce trigger here on the Raptor. So it's looking like we're going to head a little bit lower. I'm thinking, well, 46.30. Where's our support and resistance line here? 46.38 is primary support. And if we get through primary support, we'll get down to 46.28.5. These, just a real quick aside, these lines that you see here, this is part of the ultimate support and resistance suite. This is an add-on. It will work on any chart style, not just the DTS system. So if you're trading a 5-minute chart and whatnot, you can certainly add those to your chart. And one moment, I'll get you that information, and then I will finally get around to answering Bo's question for him. All right, let me just get you that link. This is going to be true for all the add-ons that you see here today. If you would like more information about the add-ons, the pricing, and so on, you can go to that link that I just put in the window. All right, so Bo asked a good question. What's the ideal stop loss and ideal profit target for an NQ day trade? Let's start with the stop loss. And sure, here, let's do it on the Raptor. Okay, I am a big one for fundamentals for stop losses. Or actually, I'm sorry, here, let's do it on the Falcon, because I'll be able to use my trade manager. So I like to use structure for placing stop losses, because remember, before the NQ can head lower here, we need that test of the extreme that I was just talking about, right? So we've had a little bit of a hiccup in the market right here. Is this enough to be a test of the extreme? Well, it's hard to say at this point because it's still early. So if I were to short this signal, now this isn't a proper signal on the Falcon, just so you know, but we're going to pretend. If I were to short this signal, where would I place my stop loss? Well, there's an itty-bitty swing right there. But there's a danger we may test the extreme. The extreme is right up here. So in this case, structure-wise, this is the better stop loss. And you can see Trade Manager says, sorry, Eric, that's out of reach. You can't afford that, but here I'm going to force it, just so we can make a point. All right, so right now, this is my best stop loss. Why? Well, because if the market brings me in, I don't want to be stopped out prematurely. And we've seen this happen in the last couple of days where the market's just kind of wandering a little bit. It'll get up here just, you know, enough to tag your your stop loss order, your trailing stop, and then it goes and falls off to your profit target and then some. Okay, that's what we want to avoid. This little hiccup. Your stop loss is nothing more than your safety net, right? Your stop loss is only there to keep you from blowing up your account. It is not there to maintain some sort of mythical risk-reward ratio. So that's why I always try to go for a fundamental stop placement, and I always try to leave it as far away as I can afford. That's where this trade manager comes in very helpful. It's limiting my risk to only 2%. So if I try to do this trade, it would say, no, sorry, Eric, you can't afford it. So I could use my support and resistance suite. I could sometimes, if you're following moving average lines where the moving average crests, that's a good spot to cover your trade. The reason is that this is where the average price crested, right? Whatever your moving average happens to be, whether it's I don't know, a 20 or a 40 or a 60 or whatever you're following. Pardon me. So that would be a decent place to place a stop. You can see it's also above our primary resistance. But I always, to answer your question, I always try to go for a fundamental stop placement. So let's take a look here at the hawk. So here we're getting a macro pullback signal. The macro pullback signal, one of our high probability signals, it's easy to recognize because everything stays in sync except the micro line. The micro line goes out of sync. So here we're getting a macro pullback signal. Where do I want to cover this trade? Same sort of problem, right? Are we going to see a bigger test of the extreme? Are we going to see the market wander a little bit? So I don't necessarily want to keep my stops right here. Now, the good thing about DTS is most times the signal captures momentum. Most times the signal will print like it did here, the first micro macro cross, and the market heads lower. Here's another first micro macro cross, the market heads higher. Here's a red bar buy, again, one of our signals. The market goes higher. But occasionally, here's a macro pullback signal that the market wasn't done wandering yet. See, it went a little bit lower first. So here's a situation where I don't want to put my stop right below that swing low. Why? Well, because the market's going to stop me out before it hits the profit target. Again, this is why you look at a fundamental place to place your stop. So here, unfortunately, it's way down here. You could use this high right here, kind of coincides with this low. At the very least, you're going to want to go somewhere to the macro line in anticipation that the macro pullback is actually going to get deeper and get into that macro line. And you can see even that one wasn't deep enough. So when in doubt, go as far away back as you can. You can always roll your stop. Right? And remember, this is merely a safety net. This is to keep you from blowing yourself up. So if you take that kind of attitude toward your stop loss, I think you're going to find yourself in a better position. Now, the other part of Bo's question is, what is an ideal target? Well, again, there it depends a little bit. If you're just looking at scalping, your ideal target is $50 per contract. We have high probability targets for our other tools. Our Falcon Swing Trader, the high probability target is $100, as is the high probability target for the Raptor, and the high probability target for the Eagle is $200. But you have to remember these tools have been programmed to find those types of situations. So I would say go for a $50 target. Now I know that doesn't sound like a lot, but here's a fact that few traders realize. If you trade for $50 per trade, even in a market like the NQ, you're not usually asking too much. Most signals you'll be able to pick up at least $50. You'll notice here on our Hawk scalper, no problem here on the first micro macro cross signal. So let's say we cover, see this one's a little bit easier. I can either cover above the swing in the micro line, or I can cover above the high. So there's $50, no problem. Macro pullback signal. Triangle hash mark print right there. Even if I cover back to the macro line, another $50. Now, I know you're thinking, well, $50, that's nothing. Well, first off, two things. You got to do what I call the sidewalk test. If you're walking down the street and you see a $50 bill on the sidewalk, are you going to stop and pick it up? I venture a guess that most of you are going to say, yeah. $50? I'll stop and pick it up. I bet there's still most of you here who will stop and pick up a quarter and feel real good about it. But here's the market offering you $50. All right, high probability signals, $50. If you do that just twice a day, just like I did, just right here, and we're not even half hour into the session, if you can do that every day, you will make $20,000 a year. I'll let that sink in there for a moment, because that's a lot of money for trading. You're going to outperform the S&P. Now, if your account is a little bit bigger And let's say you can afford to trade 2 contracts. Let's say we frame the trade like this and we take 2 contracts and you do that twice a day off your high probability targets or signals. You're going to make $40,000 a year. If your account is a little bit bigger still, or you build up your account to the point where you can trade 3 contracts, that's $60,000 a year. 5 contracts is $100,000 a year. 25 contracts is $500,000 a year. So you see, the secret to trading is not generating a plethora of signals. You don't need to have signal after signal after signal. You have to have a signal that you can take and that you can profit on. You need that high probability signal. That's why we try to focus on the high probability signals. Here, I'll load crude oil onto here so I can get to Brian's question. Bo asked a good question. So there's no specific maximum stop as a policy. Well, there is, but it's based on your account, not on the chart itself. So, for instance, most of you have been taught at one time or another that a 3-to-1 risk-reward ratio is a good idea, or reward-to-risk ratio is a good idea, right? So let's say you're looking at crude oil, and you're looking back here and you're saying, oh, wow, look at crude oil put in a high right here. So here's resistance. And now here we come with crude oil. Oops. And we're going to generate a buy signal. It's our first micro macro cross signal, and you're looking at this and you're saying, okay, if I put my if I put my entry here and I put my stop loss here and I put my target here, oh, okay, well, I don't have a 3-to-1 risk reward ratio, so instead of passing on the trade, what most of you will do is you'll say, well, okay, what if I put my stop right there? Oh, now I can get well, that's actually a 4-to-1. So I'll put my stop right here. Okay, close enough. I got a 3-to-1 reward to risk ratio. Now I'll take this trade. But what happens is you end up getting stopped out, not because you didn't have a 3-to-1 reward to risk ratio, but you weren't playing the probabilities. It's kind of like Las Vegas, right? You want to play, if you're playing blackjack, you want to play the probabilities. You know, you want to double down when you get a 3 and an 8 showing, right? Because the chances that a face card's going to come up and you're going to make 21 are that much better. Well, trading like this is very similar. But using a 3-to-1 reward to risk ratio to justify taking a long position here is nonsense. Now, your risk, Bo, and everybody else, is determined by your account size. So let's say you're trading a $10,000 account and you're going to limit your risk to 5% or less of your trading capital. That's considered prudent. The ideal amount most traders agree is 2%. So that means on any position, you're going to be risking anywhere from $200 to $500 and no more. So the trade manager already does all this work for me. This is an incredible tool. I cannot say enough good things about this tool. It was Adam's brainchild, and it took a long time to develop. But let's say I'm going to take this first micro macro cross signal. I'm going to try to cover it down here. Oh, let me set my auto target. There we go. So I'm going to enter here. I'm going to cover down here. Oh, trade manager says, sorry, Eric, you can't afford it. So right there, it's keeping me out of a potentially bad trade. All right, let's say I really want to take that first micro macro cross. All right, so Trade Manager says, okay, you can take it. You can afford to lose $280, essentially $300. That's 2% of my trading capital. So if this trade goes bust, it's not the end of the world. I've lost 300 bucks. But watch what happens. If I place my stop really tight, oh look, my trading capital or my risk exposure does not change. It remains constant. Rounding errors here. We're still talking about $250 to $300. But what has changed is my position size. I've gone from trading a single contract to trading 2 contracts. This is a very important concept, one that most traders never get a handle on, and it's to their hurt because they end up blowing up their account. All right, so here we go. Here's the other problem most traders do is they play the risk-reward ratio game, and they don't realize that they should be playing probabilities, and whereas they could have had a profit, then they end up taking a loss because the market reverses on them. So we had, again, just regarding probabilities, here's a high probability signal, that first micro macro cross signal on the hawk. Here's another first micro macro cross on the hawk on the downside. So there's our signal. Where do you want to cover this trade? Well, fundamentally, the best place is up here, but I can't afford that. All right, let's say I really want to take this first micro macro cross. Can I cover it to the macro line? All right, I can do that. $300 risk. Again, this is my safety net, yet this is an amount I can afford without blowing up my account. I have met people who have blown up, more than one person who has blown up a $20,000 account in a single session. How is that possible? Well, for starters, they're obviously not managing their risk exposure, right? And this is muy importante. Until you get a handle on that, you're always going to struggle as a trader. That's the beauty of the Trade Manager, is it never allows you to risk more than you can afford to lose. And then at the same time, it also correctly capitalizes your position. So if you did take the trade like this, okay, the risk amount stays the same, but you're maximizing your profit as well. So you're controlling your risk and maximizing your profit. That is how you cut your losses and how you let your profits run, right? This is what I refer to as the best kept secret on Wall Street. All right, here's crude oil now. So we've got, as far as the scalper goes, we've got the first micro macro cross higher, working a first micro macro cross lower, getting a little bit of heat here from the swing low. Although we just kissed our profit target. I would anticipate that it's going to try to get down there sooner or later. This may develop into a macro pullback. Why? Well, we haven't really seen a real big test of the extreme yet, have we? While we've got crude oil up here, we might as well take a look at the swing trader. Oh, these blue dots that you see here, folks, these are the stop strategies. That's the other part of the Trade Manager. We have 16 different stop strategies to choose from, and they're all customizable. So you can change them however you want. And what happens here, I'll show you this in a moment, but let's say we had sold here, placed our stop here, and then these blue dots start to appear. Trade Manager will take our stop and start rolling it according to the selected stop strategy. All right, so that's how that works, and I'll demonstrate that in a moment. Right now, no clean signal on crude. We're looking at a possible trend change signal. Are we still getting the crude inventory report today? Because of the holiday, I was wondering. Let me see here. Yeah, thanks, Felipe. I was just checking. Yeah, and Terry too. No, it's tomorrow. That's because of the holiday today. So you can probably anticipate crude oil is going to be a little bit range bound today. Like I say, we're working on a trend change signal here at the moment. The trend does seem to be down, but they're holding this support. We're right here on the primary support line. A quick look at the Eagle for crude oil. Oh, we did generate a green bar sell. This is the opposite of a red bar buy. This is what happens in a downtrend. And I won't be able to afford it, so I'll frame it this way. We're probably pretty close to our break-even trigger. So we would have at least tripped this trade to a break-even situation. And last but not least, let's take a look at the Raptor. Well, I'm just looking at the Geiger counter. Look at how hard it's over here on the sell side. I think we're going to see a little bit of a move lower here. They're chewing through those sell orders. There, they're making a little swing to the buy side. The longer this dial stays either to the buy side or the sell side, the stronger the chance that the market's going to move that direction. Here on the Raptor, yeah, we're just kind of looking a little bit. Here was a hard edge bounce prior to this morning's open. A little bit of a, here was a soft edge sell, or pardon me, a soft edge buy. Soft edge buy that had a little follow through to it. Here's a trend change signal, but honestly, that would have been difficult to take real time. Why? Well, because no test to the extreme, right? How do I know prices will fail here? I haven't seen the buyers make their final push and fail. So that's why I said that one would be a little bit tricky to try to take real time. All right, let's get the NQ back up here. There you go, NQ. Okay, a couple more questions, and Jim's been shooting me here some advanced decline numbers. So early on, it looked like we had 1480 on the buy and just under 1200 on the sell. So slightly positive advanced decline, but of course, advanced decline is relative. So you kind of, if you're following an advanced decline figure, remember where you start the day, that's your starting point. And so you try to track how the market goes from there. So currently we're kind of a positive 300, and then you can see whether it's going to go higher or lower. Yeah, Jim makes a comment here too about the support and resistance lines regarding finding profit targets and stop losses. Omar, who trades the Forex with DTS, he likes to use the support and resistance suite as profit targets and as places to cover your trade. So what he would do is, again, this isn't a true signal because the trend line is out of sync here, but we're going to pretend for a moment. Omar would very likely do something like this, where he would have his entry here, he would cover above the median line, so he'd probably cover above the swing high, and he'd take profit down here at the, or at least partial profit at the primary support. And what he may do is he may actually split his trade into thirds so that we've got he'll enter here, take part profit here. Oops, 1 second. We'll do it like this. He'll enter here, take part profit here, take part profit here, and then have a runner on for the rest of it. So prices advance, he takes profit on part of his position, and now he's looking at taking profit on a secondary contract, and all the time he would be using these levels also to roll his stops. All right, so there's another way that you can use these tools. Okay, let me just get back to your questions here. Terry is asking, are you going to take some trades as examples? Yeah, I'm going to try to show you some trades here. We're kind of, we missed some early trades out of the gate, but we'll see what we can find. Green bar sell, another nice signal here on the hawk, and also a 4-arrow consolidation. So 2 high probability signals overlapping there. Green bar sells tend to develop near the end of a trend, so I'm wondering whether the buyers are going to show up here now. I do believe the trend is down-ish. Brian's asking, can you use this system to scalp crude oil? Yes. He says, I trade crude oil with a 8 target and a 10 stop. I don't consider what you are showing a scalp. Stop loss is big. No, well, okay. Here's crude oil again while we're waiting for the NQ to set up. The stop loss is controlled by my risk exposure, whether it's big or small. Watch. See the amount? $300. See, let's go a little further. Okay, see the amount? Still $300. The risk does not change. So if the risk does not change, if I'm going to risk 2% of my capital, which, frankly, 2% is not much. If I can risk 2% of my capital, why would I not run a bigger stop? What is the probability? Now, talking probabilities, not risk-reward ratios, what is the probability that this trade will work out versus the probability that this trade will work out? Well, intuitively, it should make sense that this trade has a higher probability of working out than the one where my stop loss is right here. Why is that? Well, because if the market engages me and then gives me a little bit of heat, I have a lot more room to ride out any potential swing than if I keep my stop really, really tight. And you can see here a few minutes later, prices go down and crude oil hits my scalp target. Remember, it's not frequency of trading. I had a scalper come to me, and some of you will have heard this story already. I had a scalper come to me. He was, or a fellow come to me. He wanted me to teach him how to scalp. He said, I want you to show me how to take 100 trades a day. Because in his mind, that's what scalpers do. Scalpers take 100 trades a day. I said to him, you will never be a successful trader taking 100 trades a day. He never came back. It's not finding a lot of signals, folks. Yes, there's a certain rush associated with trading, but really there's cheaper ways to get your thrills than risking your hard-earned money. Go bungee jumping. Go race, go if you live near a racetrack, go take a race car for a spin. Take a flying lesson. There's lots of ways to get the blood pumping. What you want is high probability signals. And when you get those high probability signals, you want to maximize your earning potential without risking more than you can afford to lose. That is the winning combination. That's the secret to trading. You want to know the secret to trading? That's it right there. Find a high probability signal. Never risk more than you can afford to lose, and maximize your earning potential. Now, if you're trading crude oil, you're probably going to need to be trading a larger account in order to maximize your earnings so that you're not always trading a onesie. So, in this case, you can see even framing the trade relatively tight, I can still only take 2 contracts, and I'm trading a $17,000 account on crude oil here, on the scalper. If I were trading, say, a $25,000 account, I'd probably be able to take 3 contracts. So my earnings would increase a little bit. But the secret, high probability signal, don't risk more than you can afford. Take your profit when you have it. That's how you make money trading. And don't chase a bunch of signals. Just, like I said, I'm dealing with a fellow right now who insists on taking signal after signal after signal. He's looking at the Raptor, and he'll look at a Raptor trade like this one up here, and he'll say, why did that signal fail? I took that signal. Why did that signal fail? Okay, well, first off, that's not one of our high probability signals, so that's probably the first reason that signal failed. Second reason is it's not a high probability signal because one thing with the Raptor, and Jim's been doing a lot of work with this, is when the clouds become overextended, it's essentially showing you that the market is overbought or oversold. In this case, overbought, so a reversal becomes more likely. Then you come back and we get the cloud crossover, and now we do generate a high probability signal. Okay, so here's a high probability signal. Where are you going to cover this signal so that you don't get stopped out prematurely? See, these are all the questions that you have to ask yourself when you take a trade. Okay, we got a high probability signal. What's the danger here? The test to the extreme, of course. Sure, I could cover the trade right here and hope that the market doesn't look too far back, that the buyers don't get busy off of these lows. But would it maybe not be better to place my stop up here, especially if the risk amount is going to be the same as placing it here? It's a rhetorical question. Of course I would keep my stop further back if the risk amount remains the same. I can always roll my stop. And so here we go, taking a little heat. Okay, looks like the sellers have recommitted to the trade. I can start to roll my stops in a little bit, maybe have a break-even trigger. Oops. And this is where we're at now. So once again, the sellers have recommitted. Now I can get more aggressive. Right? If the sellers start to fail at this point, then I no longer want to be in the trade. Right? So I start rolling my stops down. I can perhaps have my stop up here. And they stop me out, and we generate another signal. And that's what you do. And you do that over and over and over again. All right, There's a few more questions here. The advanced decline actually falling a little bit. Jim says, and this is from a few minutes ago, the advanced decline was 1,300 on the buy, 1,400 on the sell. That is looking a little bit weak, isn't it? Oh, here on the Falcon, we had a late filter entry signal, which is one of our high probability signals. It occurs when the filter goes out of sync and comes back into sync, but the trend line is not, never goes out of sync. So the filter not in sync until that bar right there. So this becomes our signal bar. Things have definitely slowed a little. Yeah, like David says, that's a good one too. If you're looking for a rush, yeah, if there's a racetrack or a casino near you, that's a good way. Just take a couple $100 or whatever your limit is. See, the funny thing is a lot of people have that kind of restraint when they do go to a casino, right? They'll take $300 and they'll say, let's go have some fun at the casino. And most people, if they lose, unless they have a gambling problem, once they lose the $300, they say, okay, we had our fun, let's go home, or let's go out for dinner or whatever. And that's that. And yet, why can't you transfer that same way of thinking into trading? So many people have a hard time with that. Okay, we were looking at a probable signal. Here comes another green bar sell. Now, we know that these tend to only develop twice within a trend most times. So the green bar sell, we are getting a sell signal here. We could play the test of the extreme. The test of the extreme meaning the retest of the lows. That's entirely possible. We can also set up for the failure of the signal. In other words, we can set up to buy. And I could even cover it down there. Now the signal is not complete yet. We only have the warning dot. I think the Falcon is also working on a trend change. See, the trend line is starting to flip over here on the Falcon. The Raptor, a little bit ahead of the game already. The Raptor produced a soft edge buy. So what I'm going to do with the Raptor is I'm going to throw an order in just above this bar. So we're going to take this one on what we refer to as a second push on the entry. And let's see whether we've got that green bar sell triggering yet. Come on. And what I can do here is I can show you how the trade manager will manage the trade for us. This is a little bit ballsy because we're in a downtrend today. So for me to go counter trend a little bit, see, Jim says he's been buying the soft edge. He's been doing these retracements looking for the market to get back to the hard edge. So here the Raptor engaged us. You can see that the Trailblazer, which is a different version of the trade manager, it does not have the risk component here. So you need to know roughly what your position size should be. This is a one-click entry system. Trade manager has given me my stop down here. I'm currently using the swing high low, and you know what? I'm going to show you how it manages the trade. So I'm going to delete my profit target and my break-even trigger. Hopefully we'll see the market press a little bit higher here. And I'll be able to go to a different stop strategy. Yeah, here, I'll go to parabolics right now. Normally I go into the parabolics or the bar high low or something more aggressive when we've got a little bit of open profit. But I'll do this so that you can see how the trade manager automatically rolls the stops. So hopefully if this bar finishes higher, you're going to see the trade manager roll the stop up. Now the Geiger counter is full on the buy there. There were a lot of buy orders getting chewed up. Let's see whether that has some follow through now. The needle on the indicator hard over. All right, so did you notice that the stop rolled as that bar completed? The Geiger counter, another add-on tool. It's something that you can use on any system, on any chart, so long as you can plot it on a NinjaTrader chart. Doesn't matter whether it's a 5-minute chart or a mean Renko bar or whatever. Tick charts. Come on, buyers. Okay, things are looking, or were looking pretty good there for a moment. We'll see if we can't get the buyers to chew through some of those orders. Here's a good comment from Mark. And I'll get to Bo's question here in just a moment. Actually, I'll do Bo's question first because it's an easy one. Which of the NQ or the YM is good for a beginner day trader? Either. I prefer the NQ because I think it's got a little bit more volatility. I know Jim, one of our members, he favors the YM. Both are good. They're both $5 instruments, so it doesn't cost you as much to learn versus trading something like the Russell or the E-mini, which of course are much more expensive. So it looks like we would have gotten to our first target here. And we're getting a little bit of a reaction, but I'll see if we can't run this out a little bit just to show you how the trade manager works, managing the stops. Mark makes a very good comment here. He says, good morning, Eric. I've been experimenting with putting the NQ, the YM, and the E-mini side by side on one bird, i.e. the hawk or falcon, and just trading that bird and just looking for high probability trades. I was looking at the falcon this morning and on all three markets took 3 trades already for 2 contracts each, all in, all out, and I'm done for the morning with $600 in profit. Well done, Mark. He says the key being when the equities are in sync, so are the birds. And that's a good observation. A little aside, the late Marsh Jones had developed a trading system where he actually didn't watch the charts. What he was watching was the time and sales for the Dow, the NQ, and the E-mini. And what he noticed is that the NQ and the Dow actually led the E-mini. So if there was say a burst in buying on the NQ, and that was the YM also had a burst in buying, he knew he had a few seconds to punch in a buy order on the E-mini, and that the E-mini would follow suit. So the Geiger counter hard over again on the buy side. Come on, buyers. They're really trying to chew through some of those orders. Yeah, Tony, one of our members too, he says, That's a very good comment. If this all seems a little much, mumbo jumbo perhaps, he says, believe me, you can make a nice living using only one or two of the high probability signals and making your living by regulating your position size. I'll share another story with you guys. I forget the lady's name, and I wish I could remember her name. She used to be a housekeeper. And she saved up her money and she took a trading class. And in this trading class, they taught her one trading signal. And if memory serves, I think the trading class cost her $5,000. Now, this lady was a total newbie to trading, right? She knew absolutely nothing about trading, nothing about charting, paid $5,000, learned to trade one signal. Now she has her own housekeeper. She probably has her own team of housekeepers. She has done very well for herself. Oh, the Geiger counter is getting a little bit bearish here, so I'm going to let the trade manager manage the trade, but if you're long here, you may want to think about getting your stops in because it looks like the sellers are going to make a run for it to the downside. We're going to see a bit of a reaction here. But I'll just let you see how the trade manager continues to roll the stops according to the parabolic strategy, which is the one I've adopted. And like I said, I've got 16 different strategies here. But the point of the matter is that the lady learned the single strategy. And she learned how to identify it. She learned how to trade it properly. She had confidence in the signal. And she traded that signal. It's not that she needed to know, a bunch of different signals and a whole lot of different indicators. So Tony is absolutely correct when he says you don't need to be chasing every single signal. Yes, sometimes you actually have to wait a little bit for the signal to develop. All right, so it looks like we were able to ride out that little swing so far. Let's see if the buyers can get out above those highs. These highs are going to be the big obstacle. If we can get above 46.41, we should see a little bit of a push. Yeah, and I like what Jim says here too. He says you have to watch and see which fits. You have to study for a little while. Because for me to tell you that you need to scalp in and out at $50, it may not necessarily work for you, right? If you're the kind of person who scalps in and out and then the market goes another 10 ticks without you or 20 ticks without you and you get all bent out of shape, okay, then you're the kind of guy who needs to have, or girl, who needs to have a runner in play, right? So, because that's what fits your personality. The advanced decline numbers flip-flopping again. So Jim says we've got 1,200 on the buy, 1,600 on the sell. So it's getting a little weaker again, at least according to the advanced decline. And we're going to run into, like I said, serious resistance here at this whole 46, 41, 42 area. If we can push through there, so just watching the Geiger counter here for a moment. Come on, buyers, get over there, chew through those orders. No, it's still pretty neutral. Oh, that's a good sign. They're hard over. Oh, that's a really good sign. I think we're going to see a little pop here in a moment to the upside. You see that dial spin over and hold? Come on. Oh, they're holding to the downside. Get over to the other side. Oh, that's not good. That's a lot of sellers chewing through orders here. Oh, now the buyers got their turn. Hold it, hold it, hold it. Oh, that a boy. Hold it over. Okay, so we're through 41. Let's see if we can break 42. Or if we're going to get a late reaction. Remember, whenever we encounter the hard edge here, we normally anticipate some sort of reaction to the trade or on the market. Now, again, I'll leave the trade manager to do its thing. We'd be at our profit target, or at the very least our break even. I'm not going to snap this trade to break even. I'll leave it alone, even though we're seeing quite the struggle develop here. David's watching linear regression. He says the 46-46 line is the first standard deviation. Let's see where my support and resistance lines are falling. So we've got 46-47, which is our median line. So same neighborhood, more or less. And then primary resistance up at 46.57. We just generated a trend change signal here on the Falcon while we were watching the Raptor. And also here on the Hawk, you'll notice our first micro-macro cross signal. And here's another good example why we don't want to crowd the trade. Right? We don't want to get in so tight that we get stopped out. Better to trade with a couple fewer contracts, risk it a little deeper, increase our probability that we're going to hit our profit target. Let's go back to the action here on the Raptor. Oh, their buyers holding their own. Sellers and buyers so even. Look at this. Oh, there come the sellers. They're coming on hard. Push! That reminds me of Ray Burke. He had a trading friend who would always shout for the market to push. I wish I had Ray in the room right now. I'd need a push from him. Yeah, Tony was in the room with Ray also, so yeah, it's been a while since we've heard that. I need to touch base with Ray again, see what he's up to. Okay, the buyer's chewing through some orders here. Come on, buyers. Oh, what a battle. Well, it's to be expected. Like I said, this is a very sensitive area, and it looks like we're going to get stopped now. Parabolic's running them down. And we're going to get tapped here at about break even. Boink. There we go. So again, you know, for me, going all in, all out makes the most sense. But even if you weren't all in, all out, you had opportunity to let the market run up a little bit. Took essentially a break-even trade. I think we got, yeah, like a $10 hit. So it's, you know, not the end of the world. And that was just letting the parabolics manage the trade. We could have gotten that trade to break even also. let's see what else we got going on here this morning. Gold in a nice little decline. Here's this green bar sell now on the gold eagle. So green bar sell signal. Remember I told you that was the inverse of the red bar buy. The band nice and narrow. And then the market comes out, gives you the green bar sell. And can I cover it there? Oh, doggone crude oil. I'm going to have to put more money in the account. Gee. All right, I'll cover it above the hard edge. So a nice clean signal on crude oil on the eagle. Gold floundering a little bit here this morning. Here's gold on the Falcon. And we're working on a trend change signal here. So you can see we're falling a couple of zones on our support and resistance lines. Might be making a bit of a bottom. We do have a test of the extreme, a little one right here. See, went up, went down, came up short. Now we're coming up. We're producing our warning dots. I'm going to anticipate that the hash mark, oh, well, there's the hash mark right there. So we might be a little premature here, but price is backing off a little bit. I could even take it on the other side of the line here. And essentially looking for a retracement to the primary support. And that one too, not the highest probability. I'm kind of following the DTS signal there. Gold, like I said, is floundering somewhat. But if they're not going down, they may try to go up. The NQ very neutral. We're starting to introduce some yellow bars here. Wow, Jim says they just hit a negative 1,000 tick, which tends to be bullish. Here on the Hawk, we're generating the beginnings of a red bar buy signal. This is one of the weaker signals in our signal assortment. No, now they're going to perhaps move away from that and void the signal. Yeah, see the warning dot disappeared. No doubt it's due to this hard edge bounce here on the Eagle. And the green bar sell, one of those higher probability signals. I'd have a break-even trigger near these lows, just in case the market decides to reverse off the lows. For those of you who like trend lines. I like trend lines. If we shoot a trend line across here, you can see where there's a potential for the market to find some support. All right, well, we'll put that back on the shelf, see if we can't get a clean signal develop here before the end of the session. All right, a possible first micro macro cross. Just getting the warning dots at the moment. I'm not real enthralled with it because of this sideways range that we're seeing. You see the market, no real trend at the moment. We're kind of stuck. So when you have a trendless market, even high probability signals become riskier because we're not clear on the direction. Yeah, we're getting quite a conflict in signals here. Okay, first micro macro cross. I'm going to show this to you because there's not much going on, but this, if you're looking for a signal to follow, that may not be the best one. All right, let's see if we get some follow through here now. I'm going to try to keep my stop out of harm's way in case this does develop into a macro pullback. So that's where my stop was originally. And it looks like they slipped me a tick on the entry too, scoundrels. This low right here at 46.30, very significant. If we can press through there, we're home free. And yeah, we might be getting a break here. It was either Bo or Brian who was asking earlier about profit targets. The other thing you can use is you can use this tool right here. This is the Day Ranger. This is another add-on tool. This is very helpful for determining market volatility and how big your profit and stop losses could be or should be. So you can see the 30-day average here for the NQ is just over 200 ticks. 10-day average 186, 5-day average 195. So what does that tell me? Well, it's the market was volatile, then it got quiet, and more recently it's getting more volatile again. Yesterday's range was 196. Today we're at 134. So if I wanted, let's say we're going to round it off at 200. So if I wanted to have a say take 20% of the daily range as a profit objective, I would have a 40 tick profit target. If I had wanted to run 15% or 10% as a stop loss, 10% of the daily range as a stop loss, I would have a 20 tick stop loss. All right, it looks like I can get a little bit more aggressive with my stops. Okay, Trade Manager took it down to the break even and shoot, a little bit of a hiccup. So close. We broke 46.30, which was important, and then the market gave us that little bit of a hiccup. And now they're going into their macro pullback phase. Very interesting. Let's see if we're getting a trend change yet. The Raptor hasn't come through with a soft edge buy yet. I'm going to show you here on the Trailblazer, which is the Trade Manager, which is the one-click system. This one does not have the Risk Manager component, remember? So you need to know more or less what your average position size should be. We have had a test of the extreme here. And if we produce a buy signal, that would be what we refer to as a soft edge buy. Unfortunately, on the demo days, the signals always seem to be producing when I'm explaining something. It's not that we haven't had good signals today. We've had good opportunities. Well, as Mark pointed out, he's done pretty well today. Yeah, look, Jim, you're right. Jim says the equivolume bars are getting quite fat. This is, again, an add-on, folks. You don't need to have the DTS system. The Indicator Warehouse dynamic equivolume bars will work on any chart, Forex, stocks, futures, of course, ETFs, anything you can plot on NinjaTrader. And it will work on any chart style. Normally, equivolume bars only work on time charts, but these will work on tick charts. I'm using them here on the mean Renko bars. And it's an easy way to incorporate volume into your trading. All right, so a nice little macro pullback here. Getting a trend change signal here on the Falcon now. I'll admit these lows are making me a touch nervous. All right, here we go on the Falcon. We'll look for a second push on this entry. Can I cover it up there? Yes, I can. There's a very good chance we're going to see some buying come in here, which makes me hesitant on the sell. Yeah, here comes the Raptor now, showing a little bit more bullishness. No, that bullishness is disappearing. So comparable signal here on the Raptor. We're getting the hard edge sell. So you could sell below there or below below these current lows, whatever. And we'll get a stop loss in play here. Sure, let's go with the parabolics. Why not? So you see here on the Geiger counter, you see that selling spike that we had? That's what forced all the buyers out. See how it was heavy here on the sell side and the buyers weren't able to absorb it? So we've hit our first profit target, and we've also hit our break-even trigger on the trade. So at least we've taken profit on one. Bo is asking, he says, my Ninja 6-tick Renko bar is different than yours. It's because I'm using the Indicator Warehouse mean Renko bars. I wish they had thought of a better name for them, but the mean Renko bars, which is the chart style that I use, with the dynamic equivolume overlaid, so it incorporates the volume into the bar as well. These actually comprise the best of both worlds. We get the sensitivity of a candlestick along with the power of a range bar. So we get a range bar that focuses totally on price, takes time out of the equation, and we also get the sensitivity of a candlestick. So they're more powerful than just a regular Renko style bar. The mean Renko bar, by the way, is also available with that link that I posted earlier. For those of you who didn't get it, let me see if I can get it to you here. Where did I put it? Right there. So this is for all the add-ons you've seen here today. The support and resistance suite, the day ranger, the mean Renko bars, the Geiger counter, all those tools. All right, it's near the top of the hour. I think we're going to close up the room. If there's no other questions, if there are, type quickly. Gold just about to hit our break-even trigger on our gold trade. Oh, just came up shy of our break-even trigger. You can always force the trade to break even also, right? If you're thinking, oh, now time to go, then you can always hit your break-even trigger manually. But it looks like gold going to put in a little bit of a push here and get back to that primary resistance here around this 1089, 1090 area. So you can look for that. All right, no more questions. All right, thank you very much for your attendance today. I hope that you got a little something out of it. If you have any questions, you can always email me or Adam. And DTS owners, I will see you in the trading room again tomorrow morning. All right, so we'll catch up with you then. Bye for now.